If you have cash sitting in a checking account right now, it's doing something you might not notice. It's losing value, not because the bank is taking it, but because of something more subtle that happens every single year. Here's what's happening. The US Federal Reserve targets about 2 to 3% inflation each year to keep the economy stable, which means prices go up and your money buys less. Take something simple, a Chipotle burrito. 6 years ago, it cost around $8.50. Today, it's closer to $12. Same burrito, different price. Now let's scale that. If you had $50,000 back in 2019, you could buy roughly 5,900 burritos. Today, that same $50,000 buys about 4,200 burritos. That's 1,700 fewer burritos for the same amount of money. So where did that purchasing power go? It didn't disappear. It just shifted. And that's the first reason people invest, to not fall behind. But there's a second reason, and honestly, it's more powerful. It has to do with how money grows when you give it time. Let's say you invest $1,000 and it returns 10% in a year. That's $100, not life-changing. But in year 2, you earn 10% on $1,100, which gives you $1,210. The next year, 10% on $1,210. The money compounds on itself. If you repeat this for 20 years without adding anything, that original $1,000 becomes $6,727. Now imagine you had $1 million earning you 10% a year. That's $100,000 annually, just for having it invested. The only thing that changed is the starting amount. More money creates more leverage. So if investing makes sense, the next question is, what do you invest in? You could buy real estate, commodities like gold, collectibles, even art or Pokemon cards. There are dozens of options. But here's where most beginners get stuck. Too many choices creates paralysis. And some of those choices have problems that aren't obvious at first. Stocks, which are just shares of ownership in public companies, have 3 advantages. First, they're accessible. You don't need $500,000 to get started like you might with real estate. Second, they're liquid. You can buy a share of Coca-Cola in the morning and sell it in the afternoon if you need your money back. Try doing that with a house. You'd need to list it, find a buyer, go through escrow, 30 days minimum, often longer. And third, stocks have predictable long-term returns. Over the past 80 years, the stock market as a whole has returned about 8 to 10% annually. Not every year, but on average. That's the kind of pattern you can actually plan around. But here's what's worth noticing. Look at this chart of the S&P 500, the top 500 companies in the US. There are dips, valleys, even flat periods. But the overall direction over decades, it's up, which raises a question. If you'd invested back in 1980 and just held, what would have happened? $100 invested in the entire US stock market in 1980 would be worth over $17,000 today. Adjusted for inflation, that same $100 in 1980 equals about $393 in today's dollars. So your money didn't just keep up with inflation. It grew 44 times more than inflation, just for staying invested. Now, you might think the next step is to pick individual stocks: Apple, Microsoft, Nvidia, Tesla. And you could do that, but there's a risk most people underestimate. Let me show you what I mean. If you bought Intel stock in 2000 at its peak of $72 per share, you still wouldn't have your money back today. It's been over 20 years. Meanwhile, the S&P 500 as a whole has returned more than 4 times its value since 2000. That's the problem with individual stocks. You don't know which companies will perform well over decades. Nvidia did incredibly well. Intel didn't. And unless you have the time and expertise to research companies deeply, you're guessing. So here's what makes more sense for most people. Index funds. An index fund automatically tracks a collection of companies, like the S&P 500. By buying one investment, you own a piece of all 500 companies. Apple, Microsoft, Nvidia, Tesla, all of them in one purchase, which solves the diversification problem. But there's something else worth understanding about how this works. Index funds don't have active managers picking stocks, which means the fees are much lower. They just track an index. So when you buy an S&P 500 index fund, your money is automatically split across all 500 companies. If one company underperforms, it doesn't destroy your portfolio because you own hundreds of others. That's instant diversification. And here's the math. If you invest $500 a month, that's $6,000 a year, into the S&P 500 consistently for 35 years, your total balance would be well over $1 million. That's not a promise, it's just what the historical average suggests. But here's where people hesitate. They look at the market and think, it's at all-time highs. I should wait for it to drop. That sounds logical, but the data tells a different story. The S&P 500 spends about 8.3% of all trading days at all-time highs. That's roughly 21 days per year, and new all-time highs are usually followed by more all-time highs. If you're not invested during the best days, you miss significant gains. Look at this. If you miss just the 10 best days in the market over the past 30 years, your total returns would drop by 54%. Miss 20 days, you lose 73% of your gains. Miss 30 days, 83% less, and those best days, they're unpredictable. You can't time them. But what if the market really is overvalued? There's a financial blogger named Nick Majuli who studied this question. He looked at something called the P/E ratio, basically a measure of how expensive stocks are relative to their earnings. Higher P/E means more expensive. Lower means cheaper. And he found something interesting. When you buy stocks at a high PE ratio, when they're expensive, your returns over the next 5 years tend to be lower. That makes sense. You paid more, so you get less return. But watch what happens when you extend the timeline. As the years go by, the returns start to converge. Over any 20-year period, US stocks have had no real negative returns. Over 30 years, the returns are remarkably consistent, regardless of when you bought in. Here's a real example. In 2012, if you searched stock market overvalue, dozens of articles came up saying the market was overpriced by 50%. The S&P 500 was trading around 1,400. If you believed it was too expensive and waited, you'd have missed out. Today, it's nearly 4.5 times higher, which brings us to Nick's conclusion. Just keep buying, market high or market low. Consistency matters more than timing. The longer you hold, the less it matters what price you paid. Time smooths out the volatility. So if timing doesn't matter as much as we think, the question becomes, how do you actually put money in? There are two approaches. You can invest a lump sum all at once, or you can dollar cost average. Both work, but one is easier psychologically. Dollar cost averaging means you invest a fixed amount at regular intervals. Instead of putting in $12,000 all at once, you invest $1,000 every month for 12 months. When prices are high, your $1,000 buys fewer shares. When prices drop, it buys more shares. Over time, you average out your purchase price. This reduces the risk of putting everything in at a market peak, and it takes the emotion out of investing because it's automated. You set it, and it happens whether the market is up or down. But before you start, there's something you need to know about yourself. Not everyone should invest the same way. Your strategy depends on your goals, your time horizon, and how much risk you're comfortable with. If you're 25 years old with 40 years until retirement, you can take more risk. Even if you lose money in a downturn, you have decades to recover. But if you're 60 and retiring in 5 years, you need that money soon. You can't afford a big loss because you don't have time to make it back. The stock market averages 8 to 10% returns over the long term, but some years you'll lose money. 2008 during the financial crisis. 2020 during the pandemic. Some years will be flat. The key is having enough time to ride out the bad years and benefit from the good ones. And then there's the question of how much to actually invest. Some people say invest whatever you have. But I think the more important question is, how consistent can you be? If you're just starting out and you only have $100, maybe that's better spent investing in your own skills until you have a more stable income. But if you're earning consistently and can set aside a portion every month, even $100 or $200, that's when investing makes the most sense. The benefit isn't just the returns, it's building the habit. Consistency compounds just like the money does. So here's what it comes down to. Inflation erodes the value of cash sitting still. Compound interest rewards money that's invested over time. Index funds give you diversification without needing to pick individual stocks. Timing the market is less important than time in the market. And dollar cost averaging removes the emotional guesswork. None of this is complicated. It's just a matter of understanding what actually works and being consistent with it. That's how wealth builds, not through urgency or excitement, but through calm, steady decisions made over years. If this helped you think more clearly, hit like so more people see it, and subscribe if you want more lessons like this. Let me know what questions you still have. I'll see you in the next one.